Ladies and gentlemen, good day and welcome to Bandhan Bank Limited Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikash Mundra, Head IR at Bandhan Bank. Thank you, and over to Mr. Mundra.
Thank you, Nirav. Good evening, everyone, and a warm welcome to all the participants. It's a pleasure to have you with us today as we discuss Bandhan Bank's business and financial performance for the quarter ending June 2025. We sincerely appreciate your time and participation. Today, we will take this opportunity to provide insights into our operational activities, significant achievements and challenges, as well as offer perspectives on market conditions, strategic initiatives, and any notable changes in our business environment. To walk you through these details, we are joined by Mr. Parthapratim Sengupta, Managing Director and CEO, Mr. Ratan Kumar Kesh, Executive Director and Chief Operating Officer, Mr. Rajinder Kumar Babbar, Executive Director and Chief Business Officer, Mr. Rajiv Mantri, Chief Financial Officer, myself, Vikash Mundra, Head of Investor Relations, and our senior management team at Bandhan Bank. We are happy to answer any questions on or provide additional clarity on the current quarter's performance and our outlook moving forward. Now, I would like to invite our Managing Director and CEO, Mr. Parthapratim Sengupta, sir, to brief you all on the bank's performance. Over to you, sir.
Thank you, Vikash. Good evening, and thank you all for joining us today. On behalf of Bandhan Bank, I extend a warm welcome to all of you attending our earnings call for the first quarter of financial year 26. We are pleased to have this opportunity to share our performance and insights for the quarter. Let me begin with the macro. Despite ongoing global uncertainties, the Indian economy continues to exhibit robust resilience, underpinned by strong fundamentals and supportive policy measures. For fiscal year 25-26, the RBI has projected a real GDP growth rate of 6.5%, alongside a moderate average CPI inflation of 3.7%, reflecting a balanced and stable economic outlook. In fact, as of today, the inflation rate is even lower. In line with its commitment to fostering growth, the RBI has implemented significant monetary easing, including a 50 basis point reduction in the repo rate in June 2025. The cumulative cut since early February 25 has been 100 basis points. Furthermore, the RBI has announced a phased reduction in the CRR by 100 basis points to be implemented between September and November 25, aimed at sustaining liquidity within the banking system. This sizable liquidity, coupled with focused efforts on the transmission of monetary policy to the real economy, is further expected to stimulate the economic activity of the country. The combination of moderating inflation, a generally favorable monsoon forecast, and the introduction of the new income tax regime is expected to collectively foster a positive business environment and bolster confidence in a broad-based recovery across sectors. Taken together, these factors create a strong foundation for stability in the Indian economy and is expected to stimulate economic growth by making borrowing more affordable and encouraging investment, particularly in sectors such as housing, micro, small and medium enterprises. I now move to the performance of Bandhan Bank for Q1 FY26. Before we begin the quarterly performance review, I would like to highlight that Q1 FY26 is not aptly comparable to Q1 FY25, primarily due to the challenges we encountered in the EV segment following changes in the guardrails at the industry level. Despite these headwinds, we are performing reasonably well when benchmarked against our industry peers having microfinance in their books and other competitors, with sequential improvement in our financial performance. Further, as highlighted in our previous communications, we anticipate challenges in the EV segment to persist till second quarter of FY26, albeit on an improving trajectory. In line with this outlook, our EV portfolio has had a bearing on both our overall growth and profitability in Q1 FY26. That said, we remain cautiously optimistic. Recent regulatory and monetary interventions, such as reduction in RWA for lending to MFI and NBFC MFI, as well as PSL-related relaxations, have been constructive for this sector, and we expect to witness a gradual and steady recovery in the EEB segment over the coming months, with a positive bias emerging in the second half of the fiscal year. During the quarter, loan growth remained relatively subdued, largely due to the muted performance of the EEB book. However, non-EEB book continued to be witnessed strong growth momentum. Profitability showed moderate improvement, and we remain encouraged by the sustained strength in our key operating metrics. We further observe that increase in the proportion of secured loans in our overall portfolio, alongside a healthy rise in retail term deposits, have brought stability in both deposits and advances. These developments are contributing to a more diversified asset base and enhancing the stability and resilience of our balance sheet. In line with our guidance, we saw marginal improvement in slippages compared to the previous quarter, reflecting our continued emphasis on prudent asset quality management. Furthermore, our strong capital adequacy and comfortable liquidity position provide a robust foundation for sustained growth and improved financial performance in the quarters ahead. While my colleague and CFO, Mr. Rajiv Mantri, will provide a comprehensive overview of the financials, I would like to take this opportunity to highlight a few key developments and performance indicators from the first quarter of FY26. As of June 30, 2025, the bank's gross advances stood at 1.34 lakh crore, registering a YOY growth of 6%. On the liability side, total deposits reached 1.55 lakh crore, reflecting a robust YOY growth of 16%, significantly outpacing the growth in advances. This reflects our strategic focus on strengthening our granular liability franchise and ensuring a healthy balance sheet composition. Retail term deposits demonstrated a strong momentum, growing by 34% YOY. This performance underscores the increasing trust and engagement of individual customers and highlights the effectiveness of our distribution channels. CASA deposits now account for 27% of our total deposit base. The overall share of retail deposits remains steady at 68%, indicating a marked improvement in both granularity and stability of our deposit base. We continue to execute our diversification strategy with steady progress. During the quarter, our secured book recorded a YOY growth of 29%, resulting in an improvement in the secured portfolio mix to 52% compared to 43% a year ago. Maintaining asset quality remains the top priority. Credit costs saw a moderate improvement sequentially, and we are committed to bring them further down over the course of the year. During the quarter, we undertook technical write-offs amounting to 1,047 crore. Gross NPA stood at 5% and net NPA at 1.4%, while the PCR, the provision coverage ratio, including the technical write-offs, improved to 87.3% compared to 86.5% in the previous quarter. For Q1 FY26, net total income stood at rupees 3,483 crore with an operating profit of rupees 1,668 crore. The bank reported a PAT of rupees 372 crore for the quarter. On an annualized basis, ROA stood at 0.8%, while ROE at 6%, which witnessed a marginal improvement on a sequential basis. Our capital position remains strong, including Q1 FY26 profit. The capital adequacy ratio stands at 19.4% and Tier 1 capital at 18.6%, providing adequate headroom to support future growth. Our branch network expanded to 1,750 branches with the addition of 35 new branches during the quarter. As the microfinance environment continues to stabilize, we are confident in our ability to leverage emerging opportunities. We will remain focused on prudent risk management, identifying new avenues of growth, and further enhancing operational efficiency to drive sustained performance. In our previous communication, we highlighted the transformative initiatives undertaken by the bank, focusing on various aspects to ensure a seamless integrated customer journey and an enhanced omnichannel experience. During this quarter, we have successfully enabled all 4,400 branches, that banking units, to offer retail term deposits. I am pleased to share that over 2,000 banking units have been activated and have begun raising retail deposits. This achievement followed a comprehensive capability building exercise which involved 8,300 employees across 3,200 locations, delivered through a combination of physical and virtual outreach. This initiative has expanded our retail liability sourcing capabilities, allowing us to tap into new catchments and strengthen our approach towards granular deposit mobilization and liability resilience. In the first quarter of FY2026, the bank undertook strategic measures to reduce the cost of deposits by lowering interest rates on both savings and term deposits. The introduction of the One Bandhan initiative has fostered greater synergy across departments, culminating the successful execution of Grow Deposit, Grow Together campaign across verticals, which helped generate nearly 4,200 crore incremental retail term deposits in just 40 days. Furthermore, we launched the specialized products tailored to targeted customers in the elite segment, which are known as Elite and Elite Plus Savings Account for the HNI. Looking ahead, our focus will continue to be on driving granular retail growth, advancing product innovation, and broadening our geographic footprint. On the collections front, we have pioneered the use of WhatsApp and rich communication service channels in real time to bolster our recovery efforts for missed installments. Following a successful pilot which yielded outstanding results, 88% of the messages were successfully delivered and 80% of these led to recoveries. We have now rolled out this initiative across all banking units nationwide. The bank has made significant strides in enhancing its government and financial services. The bank is now live for collecting both direct and indirect taxes through multiple channels. We have integrated with the income tax portal for refund processing and enabled central civil pension and railway pension disbursement across all branches. Additionally, we have partnered with the Jeevan Praman portal for digital life certificates and expanded our services for defense pensioners via the Sparsh platform. The bank has also signed key MOUs, including one with the Indian Air Force for Source Salary Account, and is empaneled with the Haryana and Madhya Pradesh government for conducting government business and managing state investments. During the quarter, we have further strengthened our position by integrating with the Odisha and Rajasthan government systems for account validation and reporting, and executed an MOU with EPFO for centralized collection of employers' contributions. In the wholesale banking segment, beyond the strong growth in the secured loan book, the bank successfully closed its first debt syndication mandate for an existing client. This syndication fee marks a strategic step towards building a steady other income stream and positions Bandhan Bank among one more sophisticated lenders in the industry. Our non-fund trade book reached rupees 2,100 crore as of June 2025, which is expected to boost fee income further. We have also executed import LCs, enhancing forex inflows and current account balances. Cross-border remittance volumes are increasing, which is further strengthening our forex income potential. Our bank is strategically diversifying its portfolio with a strong focus on retail lending, particularly in secured loan segments like housing loans, gold loans, auto loans, and commercial vehicle and construction equipment loans. Leveraging its extensive branch network and large customer base, the bank is enhancing existing customer relationships while expanding through new partnerships. Emphasizing risk management, the bank integrates advanced analytics at every stage of the customer life cycle to ensure asset quality. Investments in digital platforms, CRM, and data analytics are improving customer experience and operational efficiency. Overall, we remain committed to building long-term value through disciplined growth, strong risk management and compliance culture, and continued investment in our core capabilities. These strategic pillars continue to guide our actions as we navigate the current market environment. With that, I now hand over to Rajiv Mantri, our CFO, to take you through the details of our financial performance. Thank you.
Thank you, Sengupta sir. and welcome everyone to the earnings call. We'll now move on to the business performance for the quarter. I will walk you through the key financial highlights and provide an overview of how the bank has performed. We'll start with the advances. As of March 2025, as of 30th June 2026, the gross advances stood at rupees 1.34 lakh crores, reflecting a growth of 6.4% year-on-year, and on a sequential basis, the gross advances declined by 2.5%, primarily due to a 7% contraction in our EEB portfolio. The EEB portfolio declined by about 15% year-on-year, reaching rupees 52,812 crores. This decline was mainly driven by the strategic controls we have implemented in response to the elevated sectoral risks. On the other hand, the non-EEB portfolio, which now accounts for nearly 60% of total advances, up from 59% in the previous quarter and 51% a year back, registered a robust growth of 27% year-on-year. This strong performance was driven by continued momentum across our retail assets, wholesale banking, and housing segments. Specifically, retail assets grew by 78% year-on-year, wholesale banking saw an increase of 32%, and housing grew by 15% on a year-on-year basis. The growth in retail assets was mainly supported by secure products such as commercial vehicle and equipment loans, auto loans, and gold loans. Aligned with our strategic focus on product diversification and asset quality, we continue to strengthen our secured loan portfolio across housing, wholesale banking, and retail assets. The secured book grew by 29% year-on-year and now constitutes 52% of total advances, underscoring the shift towards a more secure and diversified asset base. From a business mix standpoint, our advances remain well diversified across various segments. The EEB group lending represented 25% of total advances, SBAL at 14%, wholesale banking 28%, housing 25%, and the retail assets stood at 8% respectively. In terms of regional concentration, our top 5 states, West Bengal, Maharashtra, Gujarat, Madhya Pradesh, and Bihar, collectively accounted for 58% of total gross advances compared to 59% a year back. Notably, West Bengal remains the largest contributor at 22.8%, a slight decline from 24.1% in Q1 FY25. Moving to liabilities, as of June 30, 2025, the total deposits stood at 1.55 lakh crore compared to rupees 1.33 lakh crore in the previous year, reflecting a healthy growth of 16%. This healthy growth in deposits continued to outpace the growth in our advances, reflecting our strategic focus on balance sheet resilience and funding stability. We remain committed to building a granular and stable deposit base with a continued emphasis on retail deposits. Our total retail deposits, which comprise both CASA and retail term deposits, grew by 15% year-on-year. Within this, the retail term deposits demonstrated particularly strong momentum, growing by 34% on a year-on-year basis. The proportion of bulk deposits to total term deposits also reduced to approximately 43.6% compared to 46.3% a year ago and 45.3% in the previous quarter. This downward trend underscores our continued focus on building a more stable and granular funding base. CASA deposits stood at 41,858 crore rupees, marking a 12% quarter-on-quarter decline. This decline was primarily driven by typical Q1 seasonality as well as industry trends. Further, the CASA deposits were also impacted due to reduction in the savings interest rate implemented in April 2025, which led to reduction of some savings deposits and migration of a few balances into retail term deposits. The bank continues to place strong emphasis on deepening customer relationships and expanding its customer base. Strategic initiatives are underway to enhance our product suite, refine our value proposition across segments, and improve the engagement to drive sustained growth in deposits. Our top 5 states for deposits, which is West Bengal, Maharashtra, Uttar Pradesh, Orissa, and the NCT of Delhi, now account for 66% of total deposits. West Bengal continues to be the largest contributor, representing nearly 40% of the deposit base. I'll now move on to collections and the asset quality. The bank's overall collection efficiency, excluding NPAs, stood at 97.7% for Q1 FY26, compared to 97.9% in Q4 FY25. Within the EEB portfolio, collection efficiency for the month of June was at 97.7%, and for the full quarter of Q1 FY26, it was 97.6%. The marginal decline in collection efficiency is primarily attributable to a procedural change related to the raising of installment demand on holidays. We have given additional information on collection efficiency in our investor deck, slide 19. On the asset quality front, improvement with gross slippages at the overall bank level declining to rupees 1,553 crores in Q1 FY26 compared to 1,748 crores in the last quarter. This improvement was primarily driven by the EEB segment, whereby the slippages in the EEB portfolio moderated to rupees 1,089 crores during the quarter, down from rupees 1,349 crores in the previous quarter. Recoveries and upgrades during the quarter stood at rupees 319 crores, slightly lower than the 355 crores recorded in Q4 FY25 at the overall bank level. Additionally, the bank has undertaken technical write-offs amounting to rupees 1,047 crores during the quarter, of which write-off in the EEB portfolio was rupees 952 crores, as a result of which the gross NPA and the net NPA ratios were at 5.0% and 1.4% respectively, slightly higher than the previous quarter, mainly on account of degrowth in the overall gross advances that contributed to this increase. The PCR remained stable at 73.7%, excluding the write-offs. As guided in the last quarter's call, credit cost shows an improvement on a sequential basis. Credit cost, including the standard asset provision for the quarter, stood at 3.5% of advances, which was lower than 3.9% in the previous quarter. As of Q1 FY26, the overall DPD pool for the EEB portfolio, comprising of SMA 0, SMA 1 and SMA 2, stood at rupees 2,026 crores, representing 3.8% of the EEB advances, compared to 3.4% in Q4 FY25. The increase in percentage terms was primarily due to the sequential degrowth in the EEB portfolio. On an absolute basis, the overall EEB SMA book grew by rupees 131 crore quarter on quarter, driven largely by an increase of 145 crores in the SMA 0 category. SMA 1 remained largely stable, while SMA 2 witnessed a sequential improvement. The increase in the EEB SMA 0 book is primarily attributable to a procedural change relating to the raising of installment demand on holidays. We continue to focus on strengthening our collection infrastructure and processes with dedicated efforts to improve the overall asset quality of the EEB portfolio. I'll now move on to the quarterly profit and loss statement. The net interest income for the Q1 FY26 stood at rupees 2,757 crores, reflecting a year-on-year decline of 8%. NIM for the quarter stood at 6.4%, a decline from 6.7% in Q4 FY25. This moderation was primarily driven by an increased proportion of secured loans in the overall portfolio, a reduction in the CD ratio, the impact of the recent repo rate cut, and the continued stress from the elevated slippages. However, the decline in NIM was partially offset by an improvement in the cost of funds, which reduced by 19 basis points on a sequential basis in this quarter. This improvement was supported by rate reduction on savings deposit during the quarter, which led to this improvement. During the first quarter of FY26, the non-interest income grew by 33% year-on-year. This was contributed by higher treasury income of approximately 250 crore rupees from the sale of investments and income from third-party products, which grew by 73% year-on-year compared to the same period last year, reflecting our continued focus on diversifying revenue streams. As a result, our net total income for Q1 FY26 stood at rupees 3,483 crores, representing a year-on-year decline of 1%. Operating expenses for Q1 FY26 increased by 14% year-on-year to rupees 1,815 crores, This rise primarily reflects our continued strategic investments in talent, technology, and infrastructure, as well as the impact of higher business volume in our non-EEB segments. The operating expenses to average assets ratio for the quarter stood at 3.9%, marking a sequential decline of 23 basis points. Operating profit for the quarter was rupees 1,668 crores, nearly 6% increase sequentially. The bank reported a net profit of rupees 372 crores for the quarter, as compared to rupees 10663 crores in Q1 FY25 and rupees 318 crores in Q4 FY25. The year-on-year decline in profitability was primarily driven by a change in advances mix towards higher secured, elevated provisioning, reflecting stress in the EEB portfolio, along with the impact of technical write-offs undertaken during this quarter. On an annualized basis, the return on assets stood at 0.8%, while the return on equity was at 6%, with slight improvement compared to the previous quarter. Thank you for your patient hearing. On behalf of management team, I once again thank you for participating in this call. We will now open up the call for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from line of Concall from Citigroup. Please go ahead. Concall, may I request to proceed with your question?
Yeah. Hi. Thanks for taking the question. So firstly, with respect to disbursements, maybe of almost like 10,000 odd crores, which is down, if you can highlight in terms of how much is on account of, say, the implementation of Guardrail 2.0 and how the rejection rates have moved, and any particular geographical trends, if you can just indicate that, and how much was because of maybe the conservative approach towards growing the EEB portfolio. So that's the first question. And second question, when we look at it in terms of the vintage analysis which you provide on the disbursements, which is on, say, slide 21. So when we look at it, like even, say, disbursements of Q1 FY25 and Q2 FY25, that's rising compared to what we have disclosed maybe over a period that's now crossing almost like 4% odd. So in fact, it seems like after maybe 12 months kind of a vintage, we still see 4% slipping into NPA across the pools, okay, right from 3Q to maybe almost like Q1 of 3Q FY24 to Q1 of FY25. So is that like this is like the general nature wherein we will keep seeing like 4-5% of NPAs even from the recently written pools, or maybe there was anything specific to read into this? Yeah.
Hello, this is Vishal here. I'll take your question. The first part of your question spoke about in terms of the disbursal coming down. First quarter, every year, there is a seasonality which gets the disbursal down. So this particular year, if I have to compare it to the previous incredible year which we had in year FY25, our disbursal stood this first quarter at 10,708 for EB, and that number in corresponding was 13,721. So obviously the disbursals were slower comparatively because of the guardrails which got implemented. And these guardrails are very good at nature at a long-term perspective, but obviously there have been, on the short term, there has been a growth because of the lender norms and in terms of the rejection which has gone up, primarily due to 3 lender norms and due to also that nobody is onboarding more than 60 DPD in their books and total unsecured exposure of 2 lakhs. On the second part of your question on the vintage, if you see,
Sorry, just on this part, if you can highlight rejection rate trends as well, that would really help.
Sure. So 16 to 18% of our rejections are also coming in where there has been an overall industry default. So nobody is able to lend, and 16 to 18% of these customers are not being given loans by anyone now. considering that everybody of this 16% population has moved towards 60 DPD and above. And if we spoke about the geography, for us, because we are more recent in compared to some of the established players in Tamil Nadu and Karnataka, our disbursals in Tamil Nadu, Karnataka, though it's a small base, is also not growing up there. And some parts where we are trying to go further is also a little bit of an impediment, specifically the growth parts of UP and Gujarat. So these are geographies which are really not growing for us, and it's also true of the industry if you see. On the part of your vintage analysis, if you see slide 21, we peaked at 5.2 quarter 4 FY24. I think this trajectory, because of the leverage issues in the industry everywhere, everybody else also has worse number compared to these NPS. Ours was 5 and 4. And I think this will keep on coming down because the recent book which is showing is coming out to be much better off of, FY24 quarter 4 and FY25 quarter 1. So I foresee that this will somehow will be in the range of 3% NPA and not at the range of 4.5-5% in times to come.
Yeah.
And
Okay. So this still seems to be because of the guardrails. Yeah.
Exactly. And I would like to further add that you see last year Q1 was an exception. It was an exceptional performance for Bandhan Bank. So almost we could not also apprehend that suddenly the EV segment would reverse and it will cause worry for us for that. So it is this year, if you look at the March, it was the NPS were at 5 point, the slippages were almost 5.2% for the year. And from there, we are actually coming down for the day, mainly because EV slippages were at mean double digit for the day. So there we are actually coming down. So sequentially, if you see, there has been some improvement. But compared to a year-on-year basis, it would not be a favorable comparison because last year it was completely exceptional. I think the best Q1 the bank has ever had.
Got it. Yeah. Thanks. And all the best. Yeah.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Anand Dama from MK Global. Please go ahead.
Yeah, so thank you for the opportunity. So my first question is on your SMA 0, where I think you said that you started billing on the holidays and that's the reason the SMA portfolio has gone up. Can you explain how is that happening and what is the industry practice? Secondly, your SMA 1 and 2 portfolio has actually gone up now. So what explains that bucket movement? Is it specifically states like West Bengal or Assam, or there is something more to it? Number one. Number two question is that when do you see your 5% of the Bandhan plus 3 portfolio unwinding? Whether it will take another about 6 months for that portfolio to unwind? Because ultimately, theoretically, it has to go down to 0, right? So when that unwinding will happen?
Okay, I'll take this question again. In terms of our SMA going higher, this number has primarily happened because like what Rajiv was speaking, when he was speaking on the holidays on demand, which was a requirement, which we were not doing earlier. Demand holiday was being raised from 31st of March. And then we had 4 days in the month of April where we started raising demands for all days. And that's why you see there is an elevation on SMA 0, which however is pretty much recoverable. That is not something which is so much for us to worry upon. If you see SMA 1 and 2, largely they have been stable. SMA 1 has been stable and SMA 2 is in fact improved, and in terms of the overall number, percentage-wise is the same, simply because
that is for the EV segment. What is saying with the bank? Bank is
on the EV, sir. EV. This is EV.
Okay.
So our percentage of SMA 2 has remained flat, and overall our book of SMA 2 has come down. In fact, it's been 4.8 billion compared to 510 crores. And SMA 0, like I explained, for those 4 weekly holidays which had got billed, which was for the first time, and that impact was mainly because of in West Bengal and to some extent in Assam. That is something which we will have to live with for 1 more quarter. And every month we have been improving on that SMA number, which also had moved further up, but we are trying to control it. And that number in times of periods to come will also come down from the current level.
I think just to supplement on that, Rajiv here, that has continued to remain within the SMA 0. It has not moved on to SMA 1 and SMA 2. And as Vishal said, there are efforts in terms of how exactly that can be recovered.
So the culture is now changing in the ground also. So we are also now started collecting the installments in advance. And number 2 is that, yes, just want to tell all the investors who are there. So next this quarter, September also, so the eastern part,
we'll be celebrating the festivals, and there will be a block holidays on account of Durga Puja and others for that year. So you may see a little bit more in the rise in the SMA 0, but that's not a concern because these are all recoverable, and as Rajiv has said, it remains within the SMA 0 group for that.
So my second question was about when do you see 5% of your Bandhan plus 3 portfolio unwinding?
You see, that 5% Bandhan plus 5 is hardly any number. It's 2% today, and that is a very specific.
So Bandhan plus 3. Bandhan plus 3.
Okay, speaking of Bandhan plus 3, that is 5%. Now, over the period of, I believe, next 2 quarters, these numbers will come down to sub 2, sub 3 number, because now we have restricted the guardrail from April. So whatever is remaining over the next 2 to 3 quarters, because we have an actualization of 18-month loan, either 1 year or 2 years. So I think between the next 2 to 3 quarters, it will come down to below 3%, because we are not getting any onboarding new with Bandhan plus 3. It's only at best Bandhan plus 2. Where we have got more than 90%. Yeah. And already, I just want to emphasize that today, as we stand, and 90% of our portfolio is Bandhan plus 2. And 60% is only Bandhan, and Bandhan plus 1 is another 21%. So 81% is Bandhan plus 1 and 90% is Bandhan plus 2.
Sir, and even in your retail portfolio, there is some increase in the NPA that we have seen on a quarter-on-quarter basis. Obviously, YOY it is far more higher, 2.7 billion going up to about 3.3. Your housing also, we have seen the NPAs moving up from 7.2 billion in March 25 to about 8.1. So what explains the increase in the housing and the retail portfolio NPAs?
Okay, here at this side, on the retail portfolio, there is an old book which is like mostly in the unsecured side that is showing little stress, and we have never written off anything on those unsecured. We continue to afford to get the some collection from there. So the recent upside which is seen, it is only the unsecured book which we have done a lot of course correction during last 1.5 year. And recent book, which is a vintage analysis, is showing a greater performance there. So this is only the book which is beyond 22 and beyond.
That's a card book, right?
I think just to supplement on that, a large portion of the retail assets is really secured. There is only a small portion which is in PL, which is the unsecured piece, and I think that's where there's some bit of an increase in the delinquency we've seen. Which are the old cases?
Yeah. This is Subhash from the housing. In housing too, we have witnessed certain old portfolios which have trickled down over there, certain geography specifics also, which did show the trend, but now the trends are lowering.
Okay, sure. Thanks a lot.
Thank you. Next question is from the line of Maruk Kajania from Nuvama Wealth. Please go ahead.
Yeah, hi, good evening. I had a couple of questions. Firstly, again on the SMA 0. So given that, these are very low income groups, there is a lot of certainty that it does not roll forward. Is that the right way to put it? Because they are low income, right? So if, usually, it's a difficult guess on whether they do roll forward or not. So that's my first question. And my, you can answer that.
So we have got on the EV segment, our data proves that your SMA 1 and 2 remain stable for us, while SMA 0 has got slightly elevated. In the same month itself, these are getting recovered. So collection efficiency has inched up, you can see. So these are basically the holiday impact. Actually, the increase is that so they don't flow. Just say that we have started this thing, the collecting also on the holidays where we cannot make any collection, but the demands are raised. So obviously, in any geography, if you see there is a holiday and if my people are not there for collection, almost 1/6 of the portfolio in that particular geography will become SMA 0. So this has an impact, and because states like West Bengal and Northeast where we have a larger presence, so there are some certain festival holidays or other local festivals or something out there. Obviously, it leads to the increase in SMA 0, and it looks quite large for them. But there is nothing concerned. So that is what I'm saying, that there is no concern because these are recoverable and these are getting recovered. So what we are now trying is that we are trying to collect in advance. But it will require I would say, a cultural change, not only for our staff, but also for the borrowers, because till now they have been habituated to pay only on the due dates or at the end of the period. That is, we extend the 48 months to 52 months. So now this change is actually happening. It will take some time to stabilize, but nothing as a matter of concern as far the SMA 0 is concerned. And SMA 2 has come down, and SMA 1 also it is stable, more or less.
Okay, and my other question is that what is your general feedback on industry discipline? Of course, guardrails have been implemented, but some players are again complaining about aggressive behavior of some other lenders. So what is your take on industry discipline? And in that environment, of course, you partly answered, Kunal, but in that environment, when do you see your microfinance ETB disbursals scaling up?
So one thing I just said, while Vishal will tell about the industry perspective, that we are disciplined and we will continue to be disciplined. So the guardrails, we are following it very meticulously and we will continue. Industry-wise also, it has affected the performance of all because more or less the major players, they are implementing the guardrails, but yes.
Rajendra Baba here. Most of the players are implementing guardrails. So only means the plus and minus only few one, but all the actually players are aligned with the objective and they are making the changes.
No, I mean aggression in relending is what I am getting at, not in terms of guardrails.
Okay, so let me take this one and I'll just supplement what Partha sir and Rajendra spoke about. See, for us, like what we spoke, we have been disciplined from 2nd April. Guardrail 2.0 got implemented. We have been following very religiously and diligently. Now, somebody trying to play aggressively, in the long run, this may not be great for that particular entity. So as a rule, what MSME as a SRO association, I'm also working in terms of ensuring that guardrails which have been designed are followed on the ground by all the 82 regulated entities who have signed up for this. So there is also a report which is being published by them every quarter, whoever has not been following the guardrails appropriately. So it will all come up into light once this report is rolled out by the SRO. But having said all of this, whatever I get to hear from now, whatever have been entities who have signed up, everybody is following through the discipline pretty much the way guardrails have got designed.
Got it. So then when do you see your disbursals scaling up? I know that your growth will be slower than other segments, but still.
So I think it will still take a quarter more for everybody to stabilize this guardrail, like I spoke earlier as well. 16 to 18% of the customers who are above 60 DPD, nobody will be able to lend to them as all of us have signed up to that guardrail. So 16 to 18% customers, obviously, which were existing are no longer eligible for loans. However, having said this, considering the new borrowers which are coming up, because everybody now is trying to make their portfolio concentration and portfolio quality better, the focus has been there from the all industry players. However, the quarter two end, I believe, where the monsoon season gets over and the festive season kicks in, the momentum also shift towards more dispersal and sustainable dispersal. So my guess is maybe this quarter more is more time frame for us to be more cautious, and then quarter three onwards, the dispersal will step up. It may not step up to the way it was stepped up at a 30-40% compounded annual growth. It will be in the region of 10-15% growth from quarter three onwards.
Okay. Thanks a lot. Thank you.
Thank you very much. Next question is from the line of Piran Engineer from CLSA India. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats on the quarter. Just a few follow-ups on MFI. Firstly, have you all or the industry hiked MFI yields and processing fees?
No. We have not hiked. No yield hike, no property hike.
And no cut either?
No cut either. No cut either, and we have not hiked anything.
Understood. And just secondly, on this holiday thing, can you just once again explain it? So, like, let's say there was a holiday on 10th April, and she had to pay, but she couldn't pay, then what happens? Say on 11th, don't you all go and collect it?
So let me tell you that earlier what was happening on a holiday, the demand was not being raised. But as you know that we now being a bank, we need to comply with the IRAC norms. So the thing is that even on a holiday, like in other segments also, we now have to raise a demand. But demand is raised, but my people are not available for collection because that is a holiday for the day. So earlier this loan was getting ballooned at the end of the period. So a 48 weeks loan would have become a 52 weeks loan. But now we have to pay within a 52 weeks, we have resigned and we have to pay all on time. So what was happening initially, the borrowers or even my people also on the ground, they were also not in the habit or culture of taking the payment in advance for the day. And so it was obviously becoming an SMA 0 because it was getting collected on the next day or on the next working day whenever it happens for the day. So now we are trying to get it collected a week advance for the day. That is our effort. It will take some time to stabilize. Also, we are exploring, of course, we have not yet decided that whether we can do something similar to the bond market, that when I disclose a particular day, the next working day becomes the collecting day for the day. But that is, of course, a little bit difficult because this segment, as you know, the works on the practice, the systems, the culture built over the years for the day. So we are now majorly aiming that if we can collect a substantial portion in advance or the installment in advance, then we can save the SMA 0. So that's why I said that whenever block holidays do appear, like in September, we are apprehending that my SMA 0 will come up because of the Durga Puja happening, celebrations and block holidays in almost all the eastern states for that year. But ultimately, this does not pose to be a very much concern because collection efficiency is more than 99% and these loans also get recovered.
So I'll just
if I may just...
Kiran, I'll just add, Ratan here, I'll just add a little bit more to what Mr. Sengupta said. See, in a normal retail loan, if it is, let's say, a housing finance loan, generally the bank will raise an SI demand and it will go and hit the savings account and recover from the account. In case of EV loan, our group meetings, the loan officer will carry a tab on any day and then show that you have got 1,000 rupees installment to be paid, which means that if on a particular holiday the loan officer is not landing into a group meeting or group meeting is not happening, the practice was that you don't raise a demand and next week you go and collect it. Now that we have now ensured that we are raising the demand every day. That's number one. But we have created two more practices. One is we have now launched our QR code capability, which means that the borrower can now pay online remotely as well. A. B. We are also creating a practice of discipline that can we collect the money in advance if it is Monday installment, Monday being a holiday, can I collect it on a Saturday and request the borrower to keep the money in their savings account so that we can pool on a Monday. That is the second thing that we are doing. And the overall amount, if you see on the 53,000 crore book, the SMA 0 increase is just about 150 crore. So these are all like collectible amount. So that's the point about holiday. Have I clarified, Piran?
Partly. So, okay, I understand that digitization will help it help collections. My question was simple. Let's say 3 months in a quarter, 12 weeks. Okay, let's keep it simple. The borrower pays every Monday. Now, on one Monday, it was a holiday, so you all used to collect only 11 installments. Is my understanding correct? Not 12 installments. For those borrowers who were on a Monday.
Understanding. Exactly. Correct.
Okay. So I thought on the next Monday you would collect double, but Western.
No. We were not raising demand. So obviously demand rate is 11. We were collecting 11. Now we are raising 12 demands. And we are collecting either in advance a week before, or if on that particular day we are not able to collect, we have to go the following week to collect. And that's why that 0 to 6 comes into play. And that is what we see. Please understand, on a 53,000 crore book, 50 crore addition means 0.27, 0.28 added up today. And that like also, if you see the SMEs 1 and 2 has not, people who have not paid us, that 0.28% which is there, are still paying us every time. Correct. What they have not paid is a backlog of 1 week or 2 weeks. wherever the holiday will happen.
When we collect a week in advance, it doesn't become SMA 0. If it's paid the next week, then it's a SMA 0 but gets collected. It's only the initial piece when these holidays happen, there is a backlog to clear out, right? Which is exactly why it's continuing in the SMA 0.
But it will take some time because borrowers in the habit of paying only on the day of their week.
Getting 2 weekly payments on the following week is also not easy. And that's one of the reasons that
it
what
will
it
take
is.
some time to stabilize.
And like what sir also spoke about, in the month of September, holiday period of 4-5 days together, a decent part, will have another spike up. But like I said,
and just one more point to clarify, while QR code is there as a incremental initiative, the center meetings will continue. So I think that discipline will carry on.
Of course, yes.
Thank you very much. Kiran, sorry to interrupt you. Can I request you to come back for a follow-up question, please?
One very quick question. I'll take 30 seconds. Just what's your trajectory on NIMs, if you can guide us?
So NIM will get moderated. As you know that we have just passed 25 basis points, and now this quarter we are passing another 75 basis points. But two good things are there. My only 50% of the advances will get affected because 52% of my books are still in the fixed rate. So that's the advantage I am getting of that. Number two is that my cost of funds, as I've told you, Rajiv has already told that sequentially, because of the cut in the deposit rates, we have got a benefit of 19 basis point decrease in the cost of funds. And as and when the fixed deposit would be matured, this will be increasing because the immediate effect is only on the savings bank, not on the fixed deposit. So that a little bit will be compensated. But let me give a clear picture. NIM would be moderated, and we have to cope it up with additional business so that the quantum of profit increases.
So 4 factors to think about, Kiran, like sir said. One is clearly the repo effect. So I mean, 45% of our book is repo linked, and there could be some bit of a impact. However, we have reduced our savings rate, and we've seen the benefit of that comes in this quarter already, 19 basis points improvement in the cost of deposits. And as the term deposits come for renewal, we will see benefit of that coming through in quarter 3, quarter 4. The third is on slippages. As slippages continue to come down, we should see a benefit or an offset happening on that particular front. And fourth is as we are growing secured books faster than the EV book, I think that mix change will have an impact. So I think these 4 factors, we don't have a specific guidance, but I think these 4 factors what needs to be monitored.
Thank you very much. A request to all the participants, kindly restrict to 2 questions per participant and join the queue again for a follow-up question. Next question is from the line of Harsh Modi from JP Morgan. Please go ahead.
Hi, thanks for the call. 2 questions. First on margins, as you just explained, if I look at the mix change on the asset side with more of secured and less of EEB, even in third and fourth quarter with the FD effect coming in, do we still get sequential reduction in margin? So second quarter definitely margin goes down, if I understand you correctly. Does that continue in third and fourth quarter as well, sequentially? That's first. Second, this increased competition of some of the players kind of gaming the gentleman's code and competing a bit aggressively. Which segments, which states do we see this behavior? Is it behavior in terms of credit underwriting standards? Is it in terms of ticket size? Is it in terms of pricing? If you could give a bit more clarity around how the competitive landscape is evolving despite the guardrails 2.0. Thank you.
Maybe I'll take the first one on the NIMs. I think White have already talked about the key factors which are there. Look, I think you're right. We will be able to see, I think, some bit of a compression further in the next quarter. However, we should be able to see some level of stabilization in the second half of this year because of the offset that we expect, especially in the slippages that should try to improve. So I think that is the broad trajectory that we are looking at from a NIMs perspective. But at the same time, there are other levers that we're looking at on how do we actually increase our other income, which you've already seen a 33% growth in this particular quarter that we've done. and any further opportunities that we see in terms of improving our cost of funds, right, which will help because we are doing a lot of targeted push towards increasing our CASA mix as well. So there will be a multiple factors and levers that we'll be using in terms of how do we offset any further compression that comes through. On the second question,
I just want to understand that, Rajiv, slightly more, because the gap between your secured yield and your EB yield is quite large. And yes, we've got rate cuts and all of that has happened, and hence your cost of fund will improve. But is it enough? Or, as you said, you need a structural shift in much higher CASA balances and so on and so forth for you to even have a stabilization of NIM in second half, or knowing at least what we know and where the state of play is, a fair assumption is to expect further NIM compression in second half from second quarter levels.
No, sure. Maybe I can take that. So firstly, I think on the EB, what we had guided the market is that we will be looking at growth albeit on a moderate basis, and the secured book will grow on a faster basis. The first quarter, actually, we've seen a decline on a year-on-year basis. We expect that to start reversing out marginally the next quarter and then a bit more significantly henceforth. So as the EB book continues to improve, we'll definitely get some benefit of that to happen. Whilst we are clearly aligned towards improving our secured share and the secured mix over the next couple of years, we've already made good headway. We've already got 52% of our book as secured already. So I think we're running a little ahead of time on that particular front. I think trajectory is quite good. So we have a leeway and we have some headroom to be able to start growing our EB book as the opportunities provide.
To add to Rajiv, so what you have said is also correct, that we are also focusing in the mix of deposits. So more focus will be given from this quarter to garner CASA deposits. Yes, it is right. We have tried in the last quarter for fixed deposits because we wanted some stability in our books, and that we have been successful. In just 40 days, we could garner 4,200 crores of incremental deposits for that. This quarter, the focus is on CASA. We need to make a change in the mix of funds. So when this CASA would increase for the year, definitely it will further reduce our cost of funds.
So 2 points on the other side, just to add. One clearly is that 3/4 of our banking outlets which are distributing this EEB loan, we largely see they're out of the problem in the larger sense, which means they will be going forward doing business as usual. Of course, not grow at the pace, considering that we have the guardrails to follow. Second, clearly, the second half of the year is generally good for the industry, and therefore we expect to see a significant uptick from here on. Now, as far as the guardrail is concerned, our belief is that what we hear from the industry SRO is that most of the players and most of the significant and the large and medium players have implemented. Given that the last cycle of overheating really impacted the entire industry in a big way, our belief is that people will follow the discipline, and therefore we don't see that at least the reasonably larger medium players will derail all of that going forward soon. So to that extent, that's our belief. That's what we get to hear from the SROs at least.
I'll just supplement in terms of the numbers to get some flavor and color to this whole discussion. Yeah, industry portfolio overall has come down by 13-14% overall, if you have to compare year on year. From March 4,24,000 of 4,24,000, we are down to 3,67,000 in May. June figures of the industry are not published yet. That means 13-14% of the industry level has come down. In terms of active loans also, it's more than 16-17%. So it's not that anyone, which I've been hearing, is aggressively growing. The only thing what has come out recently is in terms of the qualification criteria of 60-40 now, qualifying criteria. So 60 can be micro for even NBFC, MFI, and that is something which everybody has to watch out for.
Sorry, could you explain that a bit more? When you say watch out for,
NBFC, MFI also could do. So like I said, overall the industry numbers have come down. I have not heard from any particular player or geography where they have grown. On the question of 60% or 40% qualification criteria is mainly for NBFC, MFI, who are now eligible to do non-MFI loans up to 40%. So we have to now watch out for individual loans, guardrail may be coming into play rather than just taking into microfinance loan. Aggressively, there would be institutions who would like to grow the individual loans because there are no guardrails there. Okay, we have guardrails only for microfinance loans. So that's something, and that's something for those entities to really figure out in terms of how do they want to build their book of individual loans or non-microfinance loans or non-micro loans.
Right.
Is that clear, or have you got the point?
Yeah, I understood. Thank you so much.
Thank you.
Thank you.
Thank you. Next question is from line of MB Mahesh from Kotak Securities. Please go ahead. So the line for the participant dropped. We move on to the next participant. Next question is from line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. First, a small clarification, Vishal. So you said that now that the qualifying criteria has been changed, so there may be further tightness on the individual loan side, right? Not the group EEB, but I mean, in your parlance, the individual MFI loans, right? Is that the understanding?
Yeah. So there would be
what Vishal was just telling is that you see now MFIs can do 40% non-micro. So there will be a little bit of aggression in the individual loans for that. Like we have got S-banks in our books. So similar to that, such schemes are there. Now in this particular loan, there are no guardrails as of now. Our industry would also like to see that it does not face the same experience as microfinance loan when due to over-leveraging, a large part of the lenders as borrowers became NPAs. So that's what he was just indicating, that maybe going forward, we may have certain guidelines for this segment too.
Correct. So, I mean, if I understand, if I look at our EEB book, while at the system level, at the aggregate level for Bandhan, the EEB book has been declining, but still the individual portion is still reasonably healthy, right? So, I mean, there is some moderation you may, if there is a further tightness there, right? That could be one outcome there.
So fair. So either like you said, that the individual loan book is behaving better than the overall group loan book, even in our side. My only contention here was there are now qualification criteria for other entities being, like you spoke about aggressiveness. It could be aggressive on the other parts of non-micro book, which
right.
Other entities will try to go because there are no guardrails there currently.
Right. So others, I mean,
anyway.
Yeah. Correct. So other means other has a lot of other business sub-segment, including as well, right? That is how you are seeing this.
Yes.
Yes. So other MFIs there, so they can now do 40% of non-micro. So there may be some sort of aggressiveness to book the individual loans. So that's what
Correct.
is indicating.
Correct. Sure. And on the credit cost side, right? So has anything changed in the sense that while the slippages are lower, and I think in the opening commentary you had mentioned that, the credit costs are slightly lower, but still on improving direction. So has there anything changed in your thought process wherein we had said that first half will have relatively higher credit costs and then it should start towards normalization going into the second half? Is there anything changes there, or is broadly the thought process?
Our guidance, what we have told earlier, remains the same. So we said that credit cost will be remaining almost at the same thing in Q1, but thankfully, we have a little bit lower credit cost compared to March quarter. So that is a good indication. Q2 will be a little bit better. Q3, Q4, we are expecting so that overall credit cost of 2.5%, as per the guidance we have given, we will try to maintain that. And still now, that is our aim. We have not changed that guidance.
Yeah, I think just to supplement, we had mentioned that we will be able to see some marginal improvement in Q1 compared to Q4. That's exactly what we've seen as well. And that's the trajectory we expect, marginal improvement in Q2 and with a more significant recovery by Q3, which is the second half.
Right. And the
Thank you.
recovery in...
Hemendra, sorry to interrupt you. I will please request you to come back for a follow-up.
Sure, thank you.
Thank you. A request to all the participants, kindly restrict to 2 questions per participant and join the queue again for a follow-up question. Next question is from line of Ankit Bihani from Nomura. Please go ahead.
Yeah. Thank you for the opportunity. I just wanted to understand that while our margins have declined 30 basis points QOQ, loan book has declined at around about 2.5% QOQ. What explains our net interest income being flat on a QOQ basis? That would be my first question.
Yeah, I think as I mentioned earlier, we actually have some improvement in the cost of funds. So our actions relating to the reduction in the savings account rates have led to almost a 19 basis points reduction in the cost of deposits. And I think that has been able to help us in terms of reducing the what we are seeing in the gross yield. The second thing is also sequentially we've seen the slippages come down marginally from roughly 1,700 odd crores to about 1,540 crores. So let me give you the exact numbers. From 1,748 crores to 1,553 crores. And that lower slippages also translates into some benefit.
It's basically the lower slippages that has happened.
And the cost of funds.
Here. And the marginally due to the cost of funds.
Okay, and another, I might have missed it earlier. So of the 1,550 crore slippages, how much would be from the MFI segment?
1089.
It's from the EB segment.
From the EB is 1089.
Okay, thank you.
Yeah. Thank you very much. Next question is from line of Puneet from Equity Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. Just 2 questions on the EEB asset quality front. So when I was looking at your vintage book, I was surprised. Like in Q4 FY25, I'm just seeing where you have given a disbursement of 151 billion, and it shows like an NPA of 0.1%. Now I know it's negligible 0.1%, but I just don't understand, like if something is disbursed in Q4 FY25 and if he's not paying 3 installments, that just makes it like immediately NPA after disbursement. How I know 0.1% is negligible, but just want clarity on that. Is it a collection issue or what is that? Because it seems like it's disbursed in Q4 FY25 and it's been classified as NPA the next quarter. So any clarity on that? Secondly, so I'll wait for this and then I'll move on to the second question. Yeah.
Yeah, I think your point is valid. It's largely due to some cross linkage and the NPA becoming due to that, which is what is causing this. It's a fairly marginal aspect, and that's the team something which they're focusing in terms of recovering as well.
But there are JAN loans also here because it is JSN. So JAN, we have a 12-month tenure loan for 50% of our loans. So 6 months have elapsed from JAN. So 0.1, some portion would also be from a January month loan, could be. And like what Rajiv said, most of it is coming primarily from a cross-linkage loans.
Sorry, cross-linkage as in didn't get that.
Cross-linkage. Some other loan would go default because talks about.
So if a person,
if there is multiple loans, one loan becomes NPA, the entire portfolio has to be part.
Okay. But I thought we had stopped. Okay, it went on NPA later. Got it.
It could be co-borrower as well. It could be co-borrower as well. It could be co-borrower linkage or any other loan linkage.
Got it. Yeah, I get it. I get that. Also, when I look at, this is just from the past 2 quarters behavior. When I look at the SMA 1 and 2 and when I track the flow, so say like this quarter, the GNPA has been constant and like 47.2, 47 book, and SMA 1 and 2 last quarter was around 5.1, 5.2 billion. That makes it an aggregated 10.3 billion. We have written off kind of 10.5. Our technical write-offs are around 10.5 billion this quarter, which is assuming all EEB, right? From the EEB book. So is it true that the SMA 1, SMA 2, the entire flow is into the NPA and then we are writing it off? And this has been for the past 2 quarters. Am I getting that thing right, or if you could correct me if something is wrong with that?
So I can explain that. So of the 10.5, almost 9.5 is EB. So a large portion is that.
Okay.
So typically for anything that we look at in terms of a technical write-off, it is for a significant level of vintage which has been there. So we first have a lot of recovery efforts that we do, and only after a considerable period has elapsed, there we look at what exactly needs to be written off, right? So it's not something which
Nothing from here would have got written.
Exactly. So it could be at least a longer vintage of portfolio that we look at.
Thank you very much. Puneet, I'll request you to come back for a follow-up question. The next question is from the line of Manish Agarwala from Phillip Capital. Please go ahead.
Your investment yield seems to have increased on a sequential basis. What explains that?
Sorry, Manish, could you repeat that question?
Your yield on investment has increased on a sequential basis. So despite your investment book declining on a sequential basis, there's a quite bit of jump on investment income. So the calculated yield looks quite steep in a potentially declining, interest rate environment. So can you please explain that?
Yeah. No, so you see the surplus in deposits because the advance growth has been muted. So obviously the funds have been deployed in investments, but investments also we are building up the trading book mostly. So if you look this quarter also, we have made substantial fee income from the investment portfolio, from the treasury portfolio. That has come because.
Sorry to interrupt, sir. If I look here in outstanding investment book that have declined on a sequential basis, my question was pertaining to your yield on investment. So the calculated yield on investment have increased by almost 70 basis points on a sequential basis. So what explains that? I understand.
I can explain that. I think on a sequential basis, the yield actually has not increased. It has slightly reduced from about 6.6% to about 6.45%. On an average basis, our investment book has actually gone up. So I think period to period end, you might be seeing a reduction, but on an average basis, it has actually gone up.
Okay.
While the yield has come down.
Manish, do you have any follow-up question?
No, thanks. I'm done. Thank you.
Thank you very much. Next question is from line of Abhishek from HSBC. Please go ahead.
Yeah, hi everyone. Good evening and thanks for taking my question. So the first question is on the EEB disbursements that you are doing now, especially the group loan disbursements. Is it mostly to existing customers or are you looking for open market acquisition, new customer acquisition as well? So what is the strategy there?
So we are doing both. It's not that only we are doing to existing borrowers. 86-87% is existing borrowers and 13-14% is coming from the new borrowers or whatever we have been discussing. But like I said, guardrails are implemented for both set of borrowers.
Sure, of course. But this 86-87, is it now higher than, say, last couple of quarters or
pretty similar.
Will it be coming lower?
We have been doing 85. We have been doing 85% of existing borrowers typically and garnering 15% from the new borrowers. The numbers remain pretty much similar.
Okay. So, and in the beginning of the call, I think you called out a few geographies where you are not growing, and therefore your growth is limited to just a few. Can you clarify where is it that you are comfortable to grow and where you're slowing down?
No, it's not like that. Our stronghold will remain East and West Bengal, Bihar, Assam, UP. That still remains a stronghold for us. Where we are not really able to grow is southern parts of India, specifically Tamil Nadu, Karnataka, because like with the guardrail of 3 lender norm, most of the players, they already have got 3 lender norms going for themselves. And like for other competition, for them to come to Bengal. So for us, growth is a little challenging in Karnataka, Tamil Nadu with all those political infringement as well. So that's place where we want to go, but we are finding it tough to go there. Rather than geography-wise, I can say more pointing was a BU-wise. That is, out of the 4,400 BUs, 3,100 are quite okay. So there we are focusing the growth already. So it is across geographies already. And more or less because the two states, they had issues in the recent past. So obviously the growth is little bit muted in those two states.
So on a full year basis this year in FY26, what kind of disbursements or let's say AUM growth are you targeting? It would still be, I don't know, 10% YOY, or what are you thinking? How do you see the trajectory?
I think it will be somewhere between 5 to 8% of growth for us in this year, FY26. And because the first quarter has been muted and it is, in fact, has gone down, I think the second half of the year will be better, and we'll have to accommodate and compensate for the first half degrowth.
Yeah, what Vishal mentioned of 5 to 8% is for the EEB portfolio.
Yeah, I'm talking of EEB portfolio.
EEB portfolio.
Yes, EEB portfolio. And overall, then you should be able to target a 10% kind of growth, right, for everything put together.
Yes. No, more than that, because our non-EB is growing at much faster pace of almost 26-27%, as you see.
So overall, 15 to 17% target is the growth target.
Okay. Thanks. And second question would be on cost of borrowings, cost of deposits actually. Just on the term deposit repricing, can you give some sense of the duration of TD and how fast you expect the deposit rate cuts to start showing up in terms of your overall deposit cost drops?
So I can say we first cut down the costs in the month of April, both savings and term deposits. The effect of savings is being seen, but term deposits as and when they get matured. But in our case, the maximum resides in the 1 year bracket. So you can say within next March, I think we will get the full benefit of this rate cut on these term deposits, because the maximum almost 60 to 70% resides in the 1 year bracket. So
just to supplement what Sir said, so savings rate was reduced by almost 30 to 80 basis points, and we saw the impact immediately in the first quarter itself, 19 basis points reduction overall on term deposits, overall on the cost of deposits. On the term deposits, I think 20 to 30 basis points reduction has happened in multiple buckets. Some we did in May, some we did in June, and I think we should see the impact from Q3 onwards.
Yeah. Okay. Got it. Thank you for those answers.
Thank you very much. Ladies and gentlemen, we will take that as our last question. I'll now hand the conference over to the management for closing comments.
Thank you. We would like to thank all of you to join for this call and would hope that you continue to place the trust with the bank. Thank you.
Thank you very much. On behalf of Bandhan Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.